Good morning, SMF Street traders. Here we are, gathered here another day, and we're going to be taking a look at the FedEx earnings reports that just came out in pre-market. Today's date is 9/16/2010, and the FedEx had ran up the last several days in anticipation, but here, let's do the thing. Earnings are $1.20 per share. That's 1 cent worse than $1.21. Revenues rose 18.1% year to year to $9.46 billion versus $9.38 billion. So this revenue is okay. The consensus earnings increased as a result of strong FedEx International priority growth at FedEx Express. The ground and benefit from the net impact of higher fuel surcharges. So looks like they have to pay a little bit higher fuel. The important thing is that the company is issuing downside guidance to $1.15 to $1.35. That is a penny shy of the street. Company raises EPS guidance to inline for 2011. And inline EPS right here is going to be roughly $4.80 to $5.25. Excluding non-reoccurring items, versus the $5.22. So it's kind of flat. FedEx will continue its FedEx Freight and FedEx National LTL operations. So basically, operational cost and cost, this is important right here, is 150 to 200 million. The bottom line is that the equity itself had ran up in anticipation. Here is a weekly chart on FedEx, and we can see the bullish patterns that occurred. However, as we have clearly stated, during this earnings season with lower GDP, and this one being in the Dow Transports during this September rally, is we've got 83.16. We closed at 85.94. And this is a fairly decent gap down in the FedEx. And today is Thursday. We have options expiration week ending Friday, tomorrow, which will be the 17th. So basically, this is the FedEx earnings report, and we're going to have a lot of lower earnings growth in the October of 2010's earnings session. Not everything, but for the most part, there are going to be some problems as far as lower growth looking forward, the way that guidances have been, the way that the re-leveraging process has worked from the stimuluses, and when the Novocaine wears off, things start to go down a little bit. There's nothing bullish about this, nor is there anything bullish about the guidance. They missed by a penny at the end of the day. Here is the weekly chart, which is very bullish. We're going to take a look and see exactly where we pull back here. I drew a trend line right here. This happens to be half of that. We've had a 3-week rally in the name here at double bottom price action. You actually come down, you dip these two little wicks right here. That was the up move. We're going to gap down below this moving average. So that means we're going to gap down. The 50-week moving averages is at 82.62. We're looking to see where support holds there. The 10-week moving average is roughly right around 81.65. But then again, the 20-week has crossed over the 50-week. So as I have said, and I've taught many SMF Street traders, is when you have a weekly moving average crossing over, and why do trends fail? Well, let's take a look at why. Number one, we were coming up toward a major topping pattern. Okay, the 20-week crossed over the 50-week and the 10-week. That means that momentum was never going to hold anyway. And we pointed this out on the S&P 500 You cannot have declining weekly moving averages and expect counter trends, or when they walk these bids up, that they're going to hold. And in this case here on FedEx, it's going to show that. And you know, we have a lot to offer you, Main Street. We have a mathematical system about weekly moving averages, monthly and yearly, longer term structured trades and things that happen, but trends in themselves, learning the true part of the trends, not hey, this is doing that and this and what if. No, it's about momentum and why momentum would not be sustainable. They never have been and they never will be when you've got long-term 20-week moving averages crossing over. That's the FedEx weekly report.